Hi everyone, thanks so much for joining me today on the Financial Management for Small Business. In this session I want to go through, we're going to look at business income, profits, sales and cash flow. Really important areas that you need to know about in your business. You know, we've heard before cash flow is king and cash is the lifeblood of our business. And we know that if we have no customers, no sales, and no cash, then we have no business, don't we? So it's a really important area that we need to be aware of when we're talking about finance. Just a general advice warning and disclaimer that the information provided in this presentation is general in nature only and does not constitute financial advice. So first up, we're going to talk about income, and I just want to unpack two different forms of income that I know we need to be aware of where our income's coming from, and that's active income and passive income. So active income can come from two places. It can come from sales, so from your business. You might sell a product or sell a service, and you're putting in your time and your effort to create those sales. And also as an employee, we might get paid wages, or people that work for someone that they're going to have active in, so they exchange their time for money. And then we have passive income, so where no time or physical effort is exerted in deriving this income. And it's things like interest earned on a bank account. You've just deposited the cash into the bank account and you receive the interest income on that. Dividends, you might own shares in publicly listed companies such as BHP or Telstra, and you've invested money in those companies, bought shares, and you receive quarterly or yearly dividends as income from that. Likewise, distributions from trusts, the same sort of thing in managed funds and exchange traded funds, etc. We have invested our money into those businesses, and we just receive the income and the distributions that come from that. We also might be a landlord. We could own residential or commercial property, and we have bought the asset, we've bought that building, that house, and we've got a tenant in there, and we derive rent where we don't have to actually physically exert our effort, and we don't have to exchange our time for money. So those are the two forms of income. Now, is sales from a business active or passive? Well, it depends on which way you look at it. So, we may be able to build a business of that works for us, and we don't have to work in it. So let's say, for instance, you're a vet and you start a veterinary clinic. You're a qualified vet, and you see the patients, and you book all the appointments, and you take all the phone calls, and you do the book work, and you do the marketing and the sales. And as entrepreneurs, we all generally start off doing those things. And in that, we're exchanging our time for money in this instance, because no one else is doing this work. But we might get to the point where we need to employ an admin person who takes some of the load from us, and we get busier and busier with more pets coming in, and we employ another vet to take some of the load from us as well. And we're now building a business that is not 100% reliant on us. Other people are earning the income for us, and we call this leveraging. We're leveraging off our staff and other people to derive some passive income for us. So as business owners, we just need to be aware of the different types of income and where it comes from. So number 2 today is profit. Now, we all need to understand what profit is. Understand, have we made a profit? Have we made a loss? May seem simple, but I've had many clients over the years come and ask me, say to me, Sarah, I don't really know if I'm making a profit. But we all probably know that total income or sales and less your total expenses equals your profit. And I assume we're all in business to make a profit, and we're not in it to make a loss. And if we are, then we probably need to have a look at changing some things. So it's important to know these three things when it comes to making a profit and being viable in business. And we're going to go through that now. It's our break-even point, it's our sales margins, and it's our work in progress. So what's your break-even point? what is the minimum amount of sales or income that you need coming in to cover costs? This is before you pay yourself, and this is before you pay your taxes. And it's important to know this because it's going to help us feel financially secure, and it's going to help us make good decisions in our business and be able to sleep at night. So let's say that you have on average about 20 customers per month coming into your business. The average customer sale that you have is, say, $550. And the total income per month, on average, we're just saying, is $11,000 per month. What you've actually worked out is that your fixed costs are $4,500 per month. And fixed costs, which we'll talk about in another session, are things that don't change very much, such as your rent, insurance, it could be telephone and internet bills, things like that, that stay the same from one month to the next, not dependent on how high your sales go. Then your total profit per month is going to be $6,500. So we've got the $11,000, we've got the $4,500 in costs, and we have a $6,500 per month profit. So your break-even point is the $4,500. It is the minimum amount that you need to cover the costs in your business. So you need to really sit down, look at your profit and losses that you've done over the last month or 2 months or a few years, and work out that what your monthly costs are that you need to pay for before you even make a dollar. It's really important to know that. The second thing is knowing what our sales margins are. So this is especially important for those who have a product base or manufacturing business. So we might buy a product X, like a wholesale product, for $165. We're then going to sell that product at a retail price for, say, $330. Then our markup is basically 100%. We're making 100% profit on what we have bought that product for. Then if you're a manufacturer, you're going to buy in some raw materials and you're going to turn that into a product to sell. So we buy that for $30. We have some direct costs to make that product. So direct costs in making that product could be wages or labour that you've paid to turn that into something on the factory floor. It could be running machines, repairs and maintenance, or electricity on machines to turn that raw materials into a saleable product. And we might retail that for $330 as well. So we've still got the same sort of margin here. We've got 165 as our margin. It's just that we have actually turned raw materials into a product instead of buying a completed product. So we really need to be aware of what our sales margins are. This is especially true for people that may be in hospitality. So you might be a cafe business. You might order in, say, protein balls for $2 from a local manufacturer, and you sell them for $4, and then you've made $2. But what we really need to be aware of is that suppliers do put prices up. And so just in case that your supplier puts that cost up to $2.50, we also need to then put our retail price up in the same vein. And sometimes that can be overlooked because suppliers don't always tell us, they just invoice us. So be really aware of your sales margins on your products. And the third area is work in progress. So this is only true, or especially true, for people that are in the service-based business, such as professional services, but it can be true for manufacturers or even tradies as well. So, we have the client bringing in the work, or they lock in the job. You go out and do the quote and the client says, yep, okay, I want to go ahead with that. Then we may receive a deposit. Sometimes we may not. I would strongly suggest that you do. Then we commence the work, we start doing the work, whatever that is. If it's professional services such as legal or accounting, you might start doing documents or tax returns or contracts, etc. And then, it's a 3 month to completion. Work commencing too for tradies could mean that you start building. So you could be a bricklayer, you start putting the bricks onto the house but then there's a 3-month completion date on that. And then you sort of get, the final payment 30 days after. So there's a big lag in that. There's about a 4-month kind of delay in those things. And so work in progress can really bank up because you've already spent your time doing client work. You've already spent your time doing the work and you haven't been paid yet. And that sometimes work in progress, if we don't monitor it, can get out of control, especially if we have a few staff and we've got a few clients. So it's a really good idea to have a software program of some sort that keeps track of work in progress that's being banked up. And even things like interim or progress invoicing or getting people to pay monthly, they're good ideas to sort of keep work in progress in check. So my last part for today is just about cash flow is king. And so why is cash flow so important to our business? I once heard the CEO of a large bank at a seminar talking to business owners about lending and about financing their business and cash flow. And the one point I took away from his talk was he just said cash flow is king. And it's so important because especially if you are a bigger business and you need to go and find some funding for your business, lending, the bank isn't just going to look at your profit and loss and go, yeah, you've made a really good profit. They're going to look at your business viability. They're going to look at, can you afford to repay this loan over the term and life of the loan? So it's important to understand our financial reports. It enables us to make informed decisions. Employees don't want to wait on paychecks and, on their paychecks for your customers to pay. The landlord doesn't care if your debtors haven't paid you. They want to be paid, So we really need to keep our cash flow in check, because we don't want to get on bad terms with suppliers or creditors either. And so what is cash flow? It's the difference between inflows, so your actual cash coming into your bank account as opposed to profits, and it's outflows. It's the actual ongoing cash, outgoing cash that is going out of your bank account. And so when we're talking about cash flow, it's not what you've billed for the month, it's not the invoices that you sent, it is the invoices that have been paid to you. It's not the supplier invoices you've received, it's the invoices that you've paid, and that's your cash flow. And cash flow includes many more things than what a profit and loss. Most people know what a profit and loss has on it, but a cash flow report or a cash flow statement has many more things in there, such as loan payments and taxes and all of the actual cash that's going out of your business. So we really need to be aware of cash flow. Over the years, I've had many clients tell me that there was only 2 numbers that they looked at in their businesses, and they were, number 1, what's their bank balance? They all knew what their bank balance was, and number 2, debtors, who owes them, the invoices to customers that they've raised for the month. They knew those figures, but unfortunately, those 2 numbers don't really tell us the financial health of a business. We could still be making a loss, but yet have money in the bank, and it's just a matter of time before we run out. So we need to predict our cash flow and budget. We need most business owners fail for lack of cash flow, not for lack of profits, because all of our profits could be going to things like taxes and loan payments that don't appear on a profit and loss statement. Many business owners are unrealistic about predicting their cash flow. They tend to overestimate income and underestimate expenses. And many times business people fail to anticipate a cash shortage and they run out of money. So we need to plan for unexpected changes that can occur. We need to have separate accounts for our business and personal expenses. That's a great budgeting tool. We need to take a set wage from our business every week and deposit it into our personal account so that we separate those things. We might have a loan offset account that we save money in. Saving for taxes, number 2, is, most people say, I don't like paying taxes. Yeah, Well, unfortunately, it's a fact of life. We live in Australia and we are one of the most highly taxed countries in the world. And the reality is that if we're making a profit as a business owner, then we're going to pay taxes, whether that's GST or income taxes as a business owner. But again, it's an area that many people fail to plan for. I've especially seen this in the trade industries, builders, plumbers, electricians, tradies, they get sick of working for someone, they decide they can do better, and, they launch out in their business on their own, they make a ton of money in the first year, they go out and buy a brand new $70,000 Toyota Hilux, and 18 months later they have a giant income tax bill and no money to pay for it. So we need to really be aware from day one, if we're making profits in our business, that we're going to probably pay taxes, and we need to get advice on this. Go and see your accountant and get the proper tax advice that you need so that you know exactly what you should be saving for. Number 3, just with some cash flow confidence, is, debtors management. So again, this is an area where many business people get into trouble. Outstanding customer payments is the biggest killer of cash flow in a business, and it can be the most overlooked. So, not getting paid on time or debtors owing people for 90 days plus is really, really going to hurt your cash flow. So there's some simple things that we can do to keep our debtors in check. It's simple things like send out monthly statements and reminder letters. If you haven't got time to do that, then get someone to do that. Try and make payment arrangements with debtors. If you know they're struggling, try and get small weekly payments off them rather than $0. And most people are grateful that you've actually offered them that option. Yearly upfront pricing is a great idea if you're in the service industry and you've got regular clients or packages that they pay over a period of time. And just have clear expectations with customers, terms and conditions set out, what they need to expect up front, and then the money stuff won't be an issue and you won't have to have the awkward conversations. Issue invoices promptly, like on the day. We have no excuse these days. We've got low cost accounting cloud software, invoicing software that we can get for, somewhere in the vicinity of $10 a month, some of them start, and we can send out digital and automated invoices so that people can, have the means of paying online as well, and even having credit card facilities online. So I hope that's helped you. Income, sales, profit and cash flow, really important areas to know in your business and to get a hold on. Hope that's helped you, and I look forward to seeing you in the next session.